So I think Bitcoin's going to get to 250,000 within a few months. And if Ethereum price ratio to Bitcoin gets back to its 8-year average, that's $12,000 for Ethereum. I mean, that's a huge move. If it gets to the 2021 highs, that's $22,000 for Ethereum. But I think Ethereum is going to become the future of finance, the payment rails of the future. And if it gets to 0.25 relative to Bitcoin, that's 62,000. So I think Ethereum at 3,000, of course, is grossly undervalued.
Tom Lee begins with a historical analogy. In 1971, the US dollar went off the gold standard. This shift forced Wall Street and global markets to innovate, create new financial products, and develop entire industries to ensure the dollar remained the center of global finance. This was not just a monetary transition, it was a structural transformation. Lee argues that Ethereum is experiencing the exact same type of inflection point right now. But this time, it's much bigger. Because in 2025, we're not only tokenizing currency, we're tokenizing everything.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Ethereum in this year, it's having its 1971 moment. I've done past dedicated videos explaining this, so I'm not going to spend much time on it today. But what I'm saying is that in 1971, the dollar went off the gold standard. And in 1971, it galvanized Wall Street to create financial products to make sure the dollar would be the reserve currency. Well, in 2025, we're tokenizing everything. So it's not just the dollar that's getting tokenized, but it's stocks, bonds, real estate. And Wall Street is again going to take advantage of that and create products onto a smart contract platform. And where they're building this is on Ethereum. This is a list of basically every major financial institution, and they're building products on the blockchain. And today, if you look at the share of real-world assets, and the prior panel talked about that, the majority of this, the vast majority, is being built on Ethereum. And not only that, but Ethereum is continuing to upgrade its capabilities, and today, the Fusaka upgrade was completed. So again, Ethereum is increasing its capabilities. And I thought this was great. This week, if you guys know Erik Voorhees, he was one of the original Bitcoin developers. Even he has said Ethereum has won the smart contract war. Okay. So that gets us to the price of Ethereum. As you know, Ethereum has been range-bound for 5 years, as I've shaded here. But it's begun to break out, and that's one of the reasons why myself and Mosaics, Shen from Mosaics is here, we got very involved with Ethereum by turning BitMine into an Ethereum treasury company because we saw this breakout coming. And maybe more importantly, the Ethereum Bitcoin ratio we think is also going to have a breakout. Now this might actually be more important because Bitcoin and Ethereum are really the two most important crypto L1s or blockchains out there. But if 2025 is about tokenization, that means Ethereum's utility value should be rising. Therefore, you should watch this ratio. Okay. Well, what does that mean for Ethereum's price? Well, I think Bitcoin's going to get to 250,000 within a few months. And if Ethereum price ratio to Bitcoin gets back to its 8-year average, that's $12,000 for Ethereum. I mean, that's a huge move. If it gets to the 2021 highs, that's $22,000 for Ethereum. But I think Ethereum is going to become the future of finance, the payment rails of the future. And if it gets to 0.25 relative to Bitcoin, that's 62,000. So I think Ethereum at 3,000, of course, is grossly undervalued. Okay. And in the final minutes, I want to talk about why tokenization is a bigger unlock than you realize. Larry Fink says we're at the beginning of tokenization of all assets. And there's 5 reasons tokenization unlocks things, okay? It's fractional ownership. It does reduce cost. It allows 24/7 global trading. There's more transparency. And in theory, there's more liquidity, okay? But I would say that these are just the raw ingredients. And in our minds, tokenization is actually going to take Wall Street into a next level of evolution. And what I mean by that is we have to understand what you can do differently if you begin to tokenize assets, especially combining it with prediction markets. For instance, most people who are talking about tokenization are doing what I call a very simplified view. They're going to take a painting like this and they'll fractionalize it so you can own one grid of this asset. But a second way to do a tokenization is to factorize a business, okay? So let's say we break this painting down into its prime colors, and then you can just buy, whatever factor you want. An example is Tesla. For instance, you can time tokenize Tesla. You can buy the NPV of earnings on a specific date. You can product tokenize. You can just buy the present value of a specific product stream. Okay, so in other words, it's blending prediction markets with actual ownership. You can geographically tokenize Tesla. You can buy the NPV of a specific region, or you can financial statement tokenize. You can buy the tokenization of its subscription revenues. These will all still solve for the price of the stock, but you're going to create an unlock that better explains the price of Tesla. For instance, we know Tesla's stock price is the sum of its future earnings. So let's say that you could tokenize and purchase a specific year of Tesla's stock earnings. And we know that Elon Musk is going to get his pay package based on a 10-year plan. So you may only want to buy the present value of 2036 earnings. So you can do that today with a prediction market, or you could actually have this as a true tokenization of the stock, and everything else is the other time periods.
MicroStrategy dominates Bitcoin treasury strategy. It trades more volume daily than JP Morgan and is the 17th most traded stock in America. BitMine, created only months ago, is already the 39th most traded U.S. stock, trading more than General Electric and nearly as much as Salesforce. Together, BitMine and MicroStrategy represent 92% of all crypto treasury trading volume across 80 companies, but their strategies diverge. MicroStrategy is becoming a digital credit vehicle, using debt to accumulate Bitcoin. BitMine is becoming an Ethereum infrastructure and DeFi bridge, staking ETH, supporting the network, investing in moonshots, and integrating with the Ethereum Foundation. BitMine holds over $12 billion of Ethereum, $900 million in cash, zero debt. Its staking program, Maven, is expected to generate 2.9%, representing $400 million per year in net income.
The second example is product tokenization. We know Tesla is EVs, robotaxis, full self-driving. I don't even have Optimus Prime, solar, but of course, ultimately, the biggest value of Tesla is Elon himself. So if you could tokenize Tesla stock, you could isolate the implied value of just buying in Elon Musk himself. And as you know, he's an N=1 person. Okay, so that's tokenization. I think, of course, you need smart contracts and prediction markets, and really working in conjunction with both is what is, in our view, a huge unlock. And in fact, BitMine is trying to find projects that are really moving this forward. So that gets us to the last point, which is, well, you can buy Ethereum because we're bullish on Ethereum, but I think you should also realize that digital asset treasuries are playing a role in transforming Wall Street. Okay, I'm going to start with Ethereum specifically, but in our view, a proper Ethereum treasury company is actually a crypto infrastructure business, and I'll explain it. First of all, Ethereum is a proof-of-stake blockchain, so Ethereum treasuries are staking Ethereum, so we're providing security. Now, In return, we get a yield, and that's revenue for the treasury companies. And we are essentially improving the security of the network, but also acting as a bridge between traditional finance and the DeFi world. And finally, stablecoin issuers are going to, in our view, ultimately want to stake Ethereum because it is the underlying base monetary layer. But for all of this to work, I think the most important element of a crypto treasury is it needs to have stock liquidity. Stock liquidity is a measure of how Wall Street views that company as relevant to the future of finance. So let's look at the two biggest treasuries. MicroStrategy today is the 17th most traded stock in the stock market today. So think about that. Like, let's say that you guys think no one cares about MicroStrategy. Wall Street certainly does. It is trading almost $4 billion a day, and it trades, it trades more trading volume than JP Morgan, for instance. Now, BitMine, which essentially was created 4 months ago, is the 39th most traded stock in America today. And as I zoom in here, you can see it trades more trading volume than General Electric, which has 30 times the market cap, and it trades almost the same trading volume as Salesforce.com, which has 20 times the market cap. So these two companies, according to the equity world, are extremely relevant. In fact, BitMine and MicroStrategy account for 92% of all crypto treasury trading volume. There's 80 crypto treasuries, and these two companies are 92% of the trading volume. And we can see that here. MicroStrategy is $3.6 billion a day. BitMine's $1.5 billion a day. After that, there's almost no trading volume. It drops off by 90%. Okay, and that's where MicroStrategy and BitMine are pursuing different strategies, because MicroStrategy is purpose-building their crypto treasury to be what Michael Saylor calls a digital credit vehicle. And he's financialized his balance sheet with a series of products, and it's been phenomenally successful. On the other hand, BitMine is bridging Wall Street and Ethereum and DeFi. So let me explain. Number one, BitMine's the largest holder of Ethereum in the world. I think that's a pretty impressive feat because 5 months ago, BitMine owned 0. Now, BitMine has announced that we have Maven, our staking solution, and when it's fully implemented, using the Caesar index, we should generate about 2.9% staking yield on our Ethereum holdings. That's about $400 million a year in net income, or $1.3 million a day. I mean, think about that for a moment. I mean, that's a lot of money. And it's done with a completely clean balance sheet. BitMine has over $12 billion worth of Ethereum, a little bit of Bitcoin, some moonshot investments, and about $900 million of cash. So there's no debt. But that's only part of it. As you can see, this is part of a DeFi strategy. The first was BitMine is doing moonshot investments. It made a big investment in ACO, which is proof of human, an ERC20 token called WorldCoin. We have our Maven staking solution that's being rolled out next year. We're working very closely with the Ethereum Foundation in partnership to really help bridge Wall Street and crypto world. We're already looking very hard at investing in DeFi projects. And of course, we're in the process of creating BitMine Labs. But that's only part of it. We're also planning to bridge finance. Because of BitMine's sizable trading volume and because of the macro experience of both Mosaics and Fundstrat, we have enormous Wall Street connectivity. We also realize that BitMine is very complementary to a lot of consumer services. It already is a very recognized brand. We are one of the most important stocks in the stock market today. There is an enormous BitMine community that already exists, and BitMine is building a lot of its own technology. So the roadmap looks good for us. We have a Made in America validator network, which is Maven. We're really investing in the crypto community and in BitMine moonshots, and of course, targeting at least 5% of the Ethereum network.
The mistake people make with something like MicroStrategy is they're like, well, it issues debt and buys Bitcoin. If they issue $1 trillion of debt and Bitcoin goes down, they're going to blow up. That is definitely true. But if you actually look at the debt, it's not that much debt. It matures over various time periods. The first piece of debt to mature is 2028. It's $1 billion. $1 billion is nothing for MicroStrategy. They could raise $1 billion tomorrow with the snap of a finger. I think they'll be able to raise $1 billion in almost any market environment. So the details just make that theoretical point just invalid. Now, I will say some of the smaller DATs, some of the MicroStrategy follow-ons that own a little bit of Bitcoin and maybe issued a lot of debt, those could blow up. That's entirely possible. I actually think the risk is not in MicroStrategy, it's in the MicroStrategy clones. And some of those could have M&A activity, they could have activist shareholders, they could have debt issues. There definitely is some risk there. I just think if you're looking at MicroStrategy for that risk, you're probably looking at the wrong horse. One way to think of it is like DATs do something and then ETFs catch up. And if the DATs don't want to trade at a discount, they have to do something else. So like first DATs bought Bitcoin and put it on the balance sheet and they traded at a premium. And then ETFs made that easier and DATs had to do something better. Now you saw DATs do. And as you mentioned, we just launched BSOL, which stakes 100% of its assets and is in an ETF wrapper. And so now if you're a Solana DAT, you have to do better than that, right? You have to do something more. So you sort of think of it as DATs leading the way, ETFs following. Every time the ETF catches up, the DAT has to do something else that's interesting. And I think that's the way to think about it. The ETF is sort of like the risk-free rate. It's what you get at low cost with high custody, with infinite liquidity. DATs can't be the risk-free rate. They need to move out the risk curve and do something hard, well, for a sustained period of time. If they do, they'll be rewarded. If they won't, they'll trade at a discount. And that's just the reality. I don't think I'm telling the DATs anything they don't know.
Ethereum's 1971 moment is not a metaphor. It is the beginning of a complete transformation of how the world stores value, transfers money, builds financial products, prices risk, and organizes economic activity. Tom Lee's message is clear and powerful. Tokenization is the next great global financial revolution. Ethereum is the platform where this revolution is being built. The world's largest institutions are already moving on to Ethereum. Ethereum treasury companies are becoming major pillars of the digital economy, and the price of ETH is nowhere near reflecting the scale of this transition. If Lee is right, the 2020s won't just be a good decade for Ethereum. They will be the decade when Ethereum becomes the backbone of global financial infrastructure.